Hello, welcome back to the show. So in today's video, I'll be covering more about Constellation Software as well as what I've done with my portfolio in the recent weeks. So for reference, this is my portfolio here. I update this weekly on the channel. But for today's video, the first topic that we'll get into is actually Constellation Software. So this stock was down around 17% year to date. And over the past few days, this stock was actually down another 10% because their legendary president, Mark Leonard, actually stepped down from his position. I think it's something to do with his health. He just hosted the AI conference a few days ago and is suddenly stepping down from his role as president. And then this new guy, his name is Mark Miller, is stepping up and becoming the president of Constellation Software. So for Constellation Software as well as Berkshire Hathaway, the reason why these two businesses have been so successful is because they have amazing capital allocators as CEO and president of each company. So for example, in Berkshire Hathaway, you have Warren Buffett, and similarly here in Constellation Software, you had Mark Leonard over the past 10, 20 years or so. And the story for Mark Leonard is over for Constellation Software. So for Constellation Software, after this stepping down of Mark Leonard, there are a few arguments to be made here. So the first one is that Constellation Software is too strong, Constellation Software is decentralized, and the company has built itself for a day like this when Mark Leonard stepped down from his position. So as you can see here, Constellation Software has many different subdivisions which are mutually exclusive to each other. So the first argument here is that despite Mark Leonard stepping down, Constellation Software will still probably operate at the same level that it historically has been. But there's a counter argument to this as well, which is that Constellation Software is simply too big for more growth. So as a company grows bigger, it becomes a victim of its own success, because the bigger the company gets, the harder it is for a company like Constellation Software to find companies that are large enough to move the needle. So for example, Warren Buffett in his early days, he used to buy very small cap companies, very catalyst-like companies. But currently now in Berkshire Hathaway, he can't do the same as well, because Berkshire has grown to such a size that even if those small companies explode to the upside, it won't move the needle for him. So it's similar to what we're seeing here with Constellation Software. The company is becoming a bit too large, and there's an argument to be made to allocate incremental amounts of capital and to achieve the same returns that it has had over the past 10 years. Nonetheless, Constellation Software is an amazing company, and you have this new CEO coming in as well. His name is Mark Miller. So Mark Miller was part of this original acquisition team, and he likely executed a lot of the plans and the positions with Mark Leonard overseeing it as well. So he actually bought a stake in the company over the past few days. So we're seeing a lot of insider buys from CEO, CFO, and so on. So for example, Mark Miller, the new president, he actually bought around 200 shares of Constellation Software just a few days ago. And this is signaling investor confidence if you're looking for management that cares for its shareholders. So for Constellation Software, the valuation is falling to a reasonable range right now. So the price to free cash flow is currently around 25 times. It is back to normality again. It's no longer too much of a premium for this company. And for Constellation Software, if you're looking to add to this position, I think this could be a reasonable time for you to do so. But the bottom line is this: for Constellation Software, it is impossible for you to understand all the different portions of the business completely. And buying Constellation Software is similar to buying Berkshire Hathaway. You buy the stock and you trust the management and the legendary status of the management. So it's impossible for you to fully evaluate this company. I don't think anyone has been able to do so. Even those that speak about Constellation Software on YouTube, most of them highlight the benefits of a decentralized system, but they don't go in depth on what exactly they do. And the main thesis for all these different investors is simply just the management team being excellent. So while I don't disagree with this, I don't necessarily agree with this as well. So for me, I'll be staying out of this one. But for Constellation Software, if you understand the business, if you understand that software businesses, then this could be an interesting one for you to look at. So I have this Substack over here as well. If you're interested in reading up on some companies, please feel free to click the link in the description. I'll be releasing an article on FICO soon, and my partner will be releasing one on Warren as well. So feel free to check it out once those are released. Next portion, I'll be covering my portfolio as well as some of the additions that I've made. So this is my new portfolio updated weekly. My cash position went down by quite a fair bit, because I added to two positions. I added to S&P Global as well as Visa. So as for my portfolio over here, I would like to review some of my losers this year. So I'll be talking about Visa, I'll be talking about Copart, and I'll be talking about PoolCorp as well. So the first stock that I'll be covering today is Visa. So Visa year to date is actually trailing the market. At one point it was up around 20%, but currently the stock is up around 7% year to date. So this stock is trading at a 32 times of earnings. And overall for Visa, it is just a stellar company that grows at 15% every single year. It is an amazing company that the market underestimates. And for Visa, as you can see here, the earnings per share growth has been stellar over the past 5 years. And the only way for this company to drop in terms of net income is if the consumer in the US weakens in times of recession. So for the US economy right now, if you have to look at this US Fed GDP data, they're actually forecasting 3.9% growth in terms of the GDP this year. So that signals strong consumer activity, which means that Visa will likely have decent earnings over the next few quarters as well. Next company that I'll be covering is PoolCorp. So PoolCorp is down around 8% year to date. It is currently trading at a 28 times of earnings. For PoolCorp, it is one of the weaker companies in my entire portfolio. It hasn't dropped to a price that is reasonable enough for me to want to continually add to this position. So for PoolCorp, it is currently a hold, maybe a sell as well if I lack the capital. And for PoolCorp, it is sort of like a macro bet as well. It's a bet on interest rates. When your interest rates are cut, your housing activity will recover. And PoolCorp will likely be a beneficiary of this. For PoolCorp, it's a decent company, not the highest quality one out there. If I was looking to concentrate my portfolio, then PoolCorp would probably be one of the first stocks I would cut out of my portfolio. The next company that I'll be covering as well is Copart. So Copart year to date is down around 20%. It is currently trading at a 28 times of earnings. So for Copart, there are a few concerns that I have with the company right now. So first of all, you have your inventory volumes declining year on year. You have your insurance volumes declining as well. And you have higher non-insured drivers, which the company says is cyclical. So that's another problem with the company right now. And besides that, the valuation of the company is not exactly sound as well. It is not amazing yet. It is currently trading at a 28 times earnings, around a 26 times forward earnings. While on a historical basis, this is decent. On a price to free cash flow basis, the company is still trading at a 34 times because of the high capex. So they're using the capex to buy a lot of land, and that's why the free cash flow is artificially suppressed. So that's why the valuation is a bit high right now. And for Copart, I think it's a company that is high quality, that is trading at fair value. So for Copart, on the other hand, you have a few different catalysts that could play out for the company, but the main catalyst will be revolving around that capital allocation. So the company now has around 10% of its entire market cap in cash. So the last time they bought back a lot of shares was in 2019. They bought the stock when it was down around 30% and it was trading at around a 26 times of earnings. So we could see something similar as well in this case. If the stock continually falls, we could see massive buybacks from the management, which will be a catalyst for Copart as well as the EPS of the company. So this is actually sort of like a catalyst link play as well for Copart. I'm hoping for the company to drop to around $40, and that will be the point where I'll add to this position. Last portion, I'll be covering some questions left in the comments. So the first one, it says, what's your opinion on Adobe? So Adobe has a quality product in my opinion. I use their products almost daily. But for Adobe, the problem is this. The company is facing competition in AI. So my aunt, she works in design. She does professional designing work. And what I've gotten from her recently is that she's incorporating a lot of AI into the ideation, into the design of the actual brochures. And she's using Adobe for the final touch-up. She's using Adobe to make sure that it is suitable. So the AI is not really trained to the extent where it can create the images that it can commercially use straight away. But in the future, we could definitely see something coming up. It makes the AI so powerful that it can be commercially used, that the products and the images produced can be commercially used. So that's the problem with Adobe. They have a significant portion of their entire user base that prioritizes photo editing. So for Adobe, it's a company with incredible metrics, trading at a decent valuation. So I don't see anything wrong adding to this company, but for me, I'll be staying out of this one for now, unless it drops to a price that is almost impossible for me to avoid it. Next question, it says, I'm also looking at Honeywell. Do you think it can be like GE and each spin-off company gets a multiple re-rating? So let me talk a bit about Honeywell. So Honeywell, I've been digging into this company. The company has an amazing aerospace business. So under that aerospace portion, they actually sell something called an auxiliary power unit. Basically, it's the back of the plane. It is used when the plane lands on the ground and when the plane takes off. So the usage time is a lot lesser as compared to your normal engines. Your engines have to function for the entire duration of your flight. But for your APU, they only use it when they land, when they're trying to generate some sort of electricity. and when they're taking off. So the usage time is a lot lesser, which means the maintenance is a lot lesser as well. So under the APU portion, they actually hold around a 65% market share. So they're quite decent in this portion. As for the other portion of the business under aerospace, they sell engines to private jets. So again, the usage time is a lot lesser as compared to a company like GE. GE is an incredible company. They sell mainly engines. And for GE, they sell the engines for commercial flights. So they sell it to Boeing, they sell it to Airbus. Whereas for Honeywell, they sell it to private jet, to your private jet company like Bombardier. So for Honeywell, their engine portion is slightly weaker as compared to GE. GE's engine portion is incredible. So to answer your question as to whether or not the company will get a re-rating, I think the aerospace portion is one that is highly likely to re-rate. As for the automations portion, that portion of the business is actually one that is weakening right now because of lowered capex. So it is similar to ASML in your chip industry. That business segment heavily relies on capex from all your different oil refineries to basically increase its earnings. And over the past few years, because of oil weaknesses, we've seen lower capex, and lower capex meant lower earnings for Honeywell's automation business. So for their automation business, they actually have two different portions. The hardware one. The hardware one has been heavily hit so far. The hardware portion is where they build out all the infrastructure, they build out all the facilities at all the refineries. As for the other portion, they actually have a software business as well under this automation segment. This high margin recurring, it's sort of like a software business, similar to your tech companies. So for this automation business, it will likely re-rate as well, similar to competitors like Schindler. So for Honeywell, on the surface, it currently looks like a decent company with a great catalyst behind of it as well. So I'm actually digging further into this company, and I'll release a full video talking about this one if I can find a thesis that is strong enough for me to want to add a significant position to this company. I hope you guys have found this one useful and invest safe.